Welcome to this tutorial. In this short video, I'll be taking you through the introduction to foreign exchange risk management. Foreign exchange risk management for a company that has transborder transaction, there will be definitely the possibility or the company will be exposed to foreign exchange risk. And what is foreign exchange risk? It is the fluctuation in the exchange rates. The fluctuation in the exchange rates. Exchange rates is the number of one country's currency to another country's currency. That's the rate at which one country's currency is exchanged for or traded for another country's currency. Currently, the Nigerian naira is being traded at 1,150 the USD. So this is the exchange rate as of today. If a company has a transaction, a Nigerian company has a transaction that has to do with the USD, the US dollar, it means that the company will be faced with the foreign exchange risk if payment is not made immediately. So let's look at the types of foreign exchange risk a company can be exposed to. Types of foreign exchange risk. The first is the transaction risk. Transaction risk. This basically occurs as a result of transaction, which is basically cross-border transaction. Cross-border transaction. The transaction will either be account receivable or accounts payable. Account receivable or account payable. You, as a company, at times you give for the receivable, your customers, say 30 days credit term. Your supplier, on the other hand, may give you 30 days credit term or 45 days or 60 days, as the case may be. If, for instance, you purchase and you defer the payment to a later date, say you pay, you make your payments in 30 days time. 30 days time. Currently, the exchange rate is 1,150 to buy the dollar. And let's assume that this transaction is worth $5,000. 5,000 USD. If payment is not made immediately, you accept the 30 days credit term and you defer the payments for 30 days. At the end of the 30 days, let's assume that the naira gets weakened and it is now 1,500 naira to get a dollar. It means that the company will need more naira to get the dollar as against 1,150. So this is when the currency moves adversely, the company loses. But if the currency moves to the favor of the company gains. So it is a risk that the receivable or the payable, for a payable now, it is the risk that the company will need more naira to make that payment. If it was a receivable, it means that the value of the dollar, the company will be afraid that the value of the dollar, $5,000, that the value will drop. So if the value of the dollar drops or depreciates against the naira, the company will be losing money. So that is the transaction risk. It is risk that occurs as a result of cross-border transaction. The next is the translation risk. The translation risk is basically a risk of translating the accounts of a subsidiary to the accounts of the parents. So these risks basically occur when group accounts are prepared. When group accounts are prepared, it is the risks arising from the translation of a subsidiary account to the parents. That is translation risk. The next and the last is the economic risk. So economic risk is just basically reduction in the present value of a company's investments in a foreign country as a result of macroeconomic variables that may work against that investment. So when the future cash flow of an investment in the foreign land is being affected permanently, the company is being faced with economic risk. So economic risk is the risk that the present value of a company cash flow will be affected as a result of unexpected adverse movement in the exchange rates or changes in the macroeconomic environments. So what are the factors affecting the exchange rates? While will the Naira, for instance, you have $1 and you have 1,150 Naira. What are those factors that will make either the Naira to be stronger or make the dollar to be stronger or weaker, as the case may be? So what are those factors? Simply put, a country's balance of payments. I'm going to explain these points one after the other, but just in summary, the balance of payment is the rate at which a company exports is exchanged for imports. So if a company imports more from a foreign country, export less, the company will need more of this foreign currency because the company is importing more, let's say dollars, for instance. When you export, your export gives you foreign currency. But if a company does not export as much as it imports, then the company will be having a deficit balance of payments, and that will result to the company needing more of the foreign currency. So let's look at those points here. Number one, the demand for the local currency. The demand for the local currency. When the demand for the local currency is more than the demand for the foreign currency, the local currency begins to gain strength against the foreign currency. On the other hand, if the demand for the local currency is very low, then it means that the local currency will continue to get weakened. The second is the demand for the foreign currency. If the foreign currency is on high demand, the country need more of the foreign currency, then it means that the local currency begins to get weakened. The next is global inflation. The global inflation is basically the purchasing power parity. Purchasing power parity, simply put, says that the inflation in two countries can be used to determine forward rates. So if country A has 10% inflation, country B has 5% inflation. The country with the higher inflation rates will suffer depreciation of currency, while the country with the lower inflation rates will, the currency of that country will keep getting stronger. So global inflation has a way of either strengthening or weakening the currency of a country. The next is political environment. So the political environment has to do with so many things. If there is instability in a country, it does mean that investors wouldn't want to invest in such an economy, and there will not be more of the foreign currency flowing into the country. And also, the political environment may also has to do with regulation, government policies, and all of these. So these political environments as a way of either strengthening or weakening the foreign currency or the local currency. The last is speculative activity. Speculative activity. When there are speculation, you find out that the exchange rate begins to fluctuate. For instance, there was a time in Nigeria that it was announced that the Central Bank of Nigeria is about to release $1.5 billion into the economy to cushion the effects of the interest rates. And once that news speculation basically arise as a result of a particular information. So the moment the information got to the markets, everybody wants to start selling off their dollar so that they will not make a loss. And for over weeks, everybody is selling, and as people are selling based on speculation, the dollar begins to get weakened. The dollar begins to get weakened as everybody keeps selling. And it will get weakened onto a point where it will now reach an equilibrium, because the demand and the supply is what will determine the exchange rates. But on the other hand, if the news was a negative news against the naira, you find out that the dollar begins to get strength because everybody wants to start buying the naira and keep. There are some people also that deals with they buy to sell. So they buy all the dollar, they keep it. When the price rise, they sell. Those are speculative activities also that has a way of affecting either the foreign currency or the local currency. Finally, is the interest rates. So also the way we have the purchasing power parity, there's also the interest rate parity, which states that the interest rate differential in two countries, country A and B, can be used to determine or predict what forward rates will be, either in a month's time, in a year's time, or 2-3 years' time. Hedging foreign exchange risk. Any country or company that has cross-border transaction will definitely face foreign exchange risk. It cannot be eliminated. The company can only minimize the exposure to foreign exchange. And how can a company minimize the risk to foreign exchange fluctuation? There are two basic methods: the internal techniques and also the external techniques. The internal technique does not require the use of financial contracts. Does not require financial contracts or the use of derivatives. internal techniques are as follows. The first is invoicing in the home currency. If you have customers in the UK and your company is in the US, you can decide to invoice the UK customer in the local currency, which is the dollar. With this, you have reduced or you have eliminated the risk of the fluctuation in the foreign currency because your invoicing is not in the foreign currency. You have invoiced in the local currency. So that risk has been hedged away. Second way is by netting. So the first is invoicing in your own currency. Okay, netting. Netting has to do with company in a group. So netting has to do with the settling of intra-group balances. So intra-group balances, if a company has two subsidiary A and B, and these subsidiaries have intra-group balances, may be payable and receivable. One will be paid while the other will be receivable. If A is owing B, to A, it is a payable, to B, it is a receivable. So the two companies can decide to net off that amount from their statement of financial position. If it is more than two companies, for two companies, it is called bilateral netting. But if it is more than two companies, it is called multilateral netting. So the next is matching. Matching has to do with a company having a receivable and a payable falling due within the same period. Receivable and payable falling due within the same period. For instance, the company has a receivable of 20,000 pounds sterling and also a payable of 20,000 pounds sterling. The company does not need to be bothered about the payable or the receivable. For the payable, the company will be troubled that, oh, I will need more of the local currency to buy the pound when this amount falls due. Since the company has a receivable in that currency, the company will not need to buy the pound. The company will simply settle the payable with this receivable of 20,000 pounds sterling. The final is leading and lagging. Leading and lagging. What does it mean to lead? To lead means making prompt payments. To lead means making prompt payments. If a company perceives that the exchange rates in, say, 30 days' time will not be favorable, the company may decide to make prompt payments by that we call it leading. While lagging, on the other hand, means delaying payments. Delaying payments. So a company may decide to delay payments and accept the credit term that the supplier has given if the company perceives that the foreign currency will get weakened in the future days, maybe 30 days or 45 days. And if that is the case, if it gets weakened, the company will need less of the local currency to purchase the foreign currency. These are the internal hedging technique. Now, the external hedging techniques, they are techniques that require the use of financial contracts. They require the use of financial contracts. These are the external hedging technique. The forward contracts, the money market hedge, futures, currency option, and the swap. So these are the external hedging techniques. In this video, I will only be taking one of these techniques, which is the forward contracts. People only take the forward contracts. Before I go into the calculation of the forward contract, I would like to do a little explanation about the forward rates and the spot rates. The spot rate is the rate for immediate settlements. Is the rate for immediate settlements. So if a company wants to lead, the company wants to make payments today, the company is the spot rate that we apply. The bid price, now this is from the perspective of the bank. It's the bank that puts the bid price, and the bid price is the buying price. Is the buying price. The bank will buy at this price. The offer price is the price the bank is offering those that wants to buy. So it is the selling price from the bank's perspective. The selling price. The spread. So you will see something like this. Let's say 1.200 to 1.2003 the pound sterling. So there is the difference between the selling price, which is the offer price, and the buying price, which is the bid price, is known as the spread. So that is the gain that the bank will make when they buy at this rate and they sell at the higher rates. That is known as the spread. The base currency is the currency for which one country's the base currency is the currency for which exchange rates is quoted. That is the currency that is being priced. So like the diagram I have before, let me use this here. 360 to 365 per the dollar. The dollar is the currency that is being priced. It's the dollar that is being priced. You are either buying or selling the dollar. So the dollar is the currency that is being priced, and it is known as the base currency. It's known as the base currency. The next is the pricing currency. The pricing currency. So the pricing currency in this example here is the Naira. So the pricing currency is the currency for pricing another. So the currency that is being priced is the dollar. That's what you want to buy or sell. The currency that you are using to buy or sell is known as the pricing currency. So you are using the naira to buy or sell the dollar. I want you to pay more attention at that point. Direct quotes. So there are three basic things you need to know in your forward contracts. The first is the quotation. Very important. You need to know the quotation. So direct, we have two types of quotation. It's either it's a direct quote or an indirect quote. So what is the direct quotes? The direct quotes, let me use the former example. So the direct quote, when 1 unit of a foreign currency is expressed in terms of the domestic. If you look at this, you see that if Nigeria is a local currency, Nigeria is a local country and Naira is a local currency, this quotation will be what? A direct quote. So 360 to 368 are the foreign currency. So this is a direct quote if Nigeria or if the Naira is the local currency. Another way to get that, say 360 to 368 per dollar, quotation Naira per dollar. So the pricing currency, anytime the pricing currency is in the local currency, it is a direct quote. Anytime the pricing currency is in the local currency, it is a direct quote. It makes more sense for you to say you are buying the dollar because you are pricing the dollar. The dollar here is the currency that is being priced. You are using the naira to price the dollar, so you are buying the dollar. So since this pricing currency is in the local currency, it is a direct quote. On the other hand, if the pricing currency is in the foreign currency, it is an indirect quote. Like this example here. If Nigeria is the domestic country, and you have a quotation like this, 0.00027 to 0.0028 naira per dollar. So it makes more sense for you to use naira to buy the dollar, but you cannot. In Nigeria, now you cannot be using the dollar to buy naira. So it makes it look like an abnormal situation. So anything that looks abnormal, I normally call it the indirect quotes. A recap again, when the pricing currency is in the local currency, it is a direct quote. If the pricing currency is in the foreign currency, it is an indirect quote. Spot rate quotation. How are spot rates quoted? From this first quotation here, we have the first currency, we have the second currency, and we know what the spread will be. From the second quotation here, it is a little bit different. You will need to determine what the spread will be. For B, this can be adjusted as follows: 1.6703 plus or minus. So the minus will come first. You have 1.6, 0.703 minus 0.0003. And that will give, if you do the calculation, it will give 1.6700. So I bring the 1.6700 first. 2, the second is the plus comes next, 1.6703 plus 0.0003. So this should give 1.6706. 1.6706. Anytime your examiner give you a question in the second format, so you need to do the adjustments by, first of all, deducting this that will give you the first. Then secondly, you add, that will give you the second per the euro. The euro. Now let's determine how do you know which rates should be the buying rates and which rates should be the selling rates. How do you know the rates that should be the buying rates and the rates that should be the selling rates? For a direct quote, it is different from an indirect quote. So when the quotation is direct, in this question here, I'm assuming that Nigeria is the home country. $360 to 368 per 360 naira, sorry, to 368 naira per the dollar. So is this quotation a direct quote or an indirect quote? I want you to look at it. Is it direct or indirect? Okay. This is the pricing currency. So anytime the pricing currency is in the local currency, it is what? A direct quote. And for a direct quote, you have buy and sell. The first rate, which is 360, will be the buying rate, and the second rate, 368, will be the selling rate. This is from the bank perspective. So for a receivable, if a company has a receivable, for a receivable, the bank will always be buying. For a receivable, the bank will always be buying. For a payable, the bank will always be selling. The bank will always be selling, because for a payable, the company needs to buy, so the bank will sell. So for a direct quote, the bank will always buy at this rate and sell at this rate. And indirect quotes, it is the opposite. It is the opposite for the indirect quotes. Assuming Nigeria is the home country also, is this a direct or indirect quotes? It is indirect, because the pricing currency is in the foreign currency. So it is indirect. And for an indirect quotes, basically the bank will sell and buy. So the selling comes first, 0.0027, 0.0028. So for an indirect quote, the bank will sell at the first rate and buy at the second rate. Let me bring it down a little. the direct quotes, it is quoted in the local currency. The pricing currency is in the local currency. For the indirect quote, the pricing currency is the foreign currency. But these rates here, which is the buying rates, the selling rates, here it is the higher rates, and this is the lower rates. If I convert this to an indirect quote, this is what I'm going to get. If I convert this to an indirect quote, this is what I'm going to get. So I can say 1/360. That will give me 1/368. So 1/360 will give me this rate here. 1/368 will give me this rate here. So if I convert this to an indirect quote, the buying rate still remain this rate. The selling rate still remain this rate, the buying rate still remain this rate. So in my next video, I will be walking you through the forward contracts, how to calculate the forward contracts, and also show you some of the techniques that you need for your exam. So finally, for a direct quote, you will need to convert. So when you are converting for a direct quote, you multiply. For an indirect quote, you divide. For a direct quote, you multiply. For an indirect quote, you divide. So there are three basic things you need for your forward contracts. There's 3 steps. The first is how to determine the quotation, determination of the quotation, direct or indirect. The second thing, you need to know the buying or the selling rates. And then last is conversion. What to do while converting. Is it to multiply or to divide? So these are the basic 3 steps for the forward contracts. So in the next video, I'll solve 1 or 2 examples on the forward contracts. Thank you. If you like the video, you can subscribe to my channel. You can also drop a comment. If you want me to treat any topic that you do not understand, you can drop a comment in the comment section.